Hello, I'm Julie Price and welcome to Juniper's first quarter 2022 economic review. I'm so glad you tuned in. Thank you very much. At the start of a new year, the economy and financial markets are still being impacted by COVID-19. However, 2 years into the pandemic, these impacts are slowly beginning to fade. In part, this is because almost all Americans now have some immunity to the virus, either through vaccination or infection. It is also because the American economy has now adapted to the pandemic, with many people simply resuming their normal activities and others adjusting their lifestyles to provide themselves with greater protection from infection while still fully participating in the economy. This has allowed the U.S. economy to fully recover from the pandemic recession, and following a weak third quarter, economic growth is accelerating over the winter. This acceleration has prompted a sharp fall in the unemployment rate and has contributed to strong growth in corporate profits. However, it has also been accompanied by some of the strongest inflation we've seen in 40 years. Both economic improvement and higher inflation has prompted the Federal Reserve to accelerate the pace at which it's tapering its bond purchases and project multiple increases in short-term interest rates in 2022. Fiscal policy will also be much less supportive in the year ahead. Despite a less friendly Washington, U.S. stocks saw a third consecutive year of very strong gains in 2021, while only long-term interest rates rose modestly. However, as interest rates rise and pandemic uncertainty falls in the year ahead, high valuations appear likely to limit long-term returns from both U.S. equity and traditional fixed income, increasing the need for a more diversified approach. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. We start with an update on the progress of the pandemic and fiscal policy. We then look at the pace of recovery, considering trends in economic growth, jobs, profit, and inflation. This is followed by comments on fiscal and monetary policy. Finally, we consider the implications of all this for those investing in U.S. fixed income and equities, as well as international equities, and highlight the importance of investing in a diversified way in the still rapidly changing environment. Join me while I discuss these topics and more using analyses from the experts at JP Morgan. Let's start by looking at where we are with the pandemic. The chart on the left shows new confirmed cases and fatalities. After a decline last summer, cases and fatalities surged in the fall due to the Delta variant, and is now surging again due to the emergence of the Omicron variant. Assuming there are no additional dominant variants, both cases and fatalities should peak in the weeks ahead, reflecting more widespread immunity from vaccinations and prior infections. The right side shows that between vaccinations and infections, over 90% of the U.S. population has at least some immunity to COVID-19. This should allow cases and fatalities to fall in the months ahead. While the pandemic isn't over yet, many parts of the economy have adapted to operate in a pandemic environment. We all hope that the pandemic itself will fade as we move through 2022, but whether it does or not, it should have much less of an impact on the economy than it has over the last 2 years. High-frequency economic activity uses credit and debit card transactional data to measure how much consumers are engaging in economic activities. 0% is the baseline, so data below the line indicate that consumers have pulled back. There was a sharp and immediate drop at the onset of the pandemic, which has gradually improved over the last 2 years. Debit and credit card transactions surged in 2021, with some thanks to enormous fiscal stimulus. However, hotel occupancy, seated dinners, and traveler traffic are still operating below zero and have recently dropped even more with the onset of the Omicron variant. Apart from vaccinations, unprecedented fiscal stimulus from both the previous and current administrations has proven to be a powerful accelerant for the economic recovery. Indeed, legislation passed in the last 2 fiscal years has added $5.3 trillion to the economy. But this stimulus is likely to drop sharply in 2022. This slide shows the impact of the recession and fiscal stimulus on the federal budget, according to the Congressional Budget Office, before accounting for the impact of the infrastructure bill and the Build Back Better plan. It also assumes the tax cuts and the 2017 Tax Act expires on schedule in 2026. On the left side, the CBO is assuming a continuation of very low long-term interest rates, even in the midst of an economic recovery and huge deficit spending. However, even if we include an extension of the tax cuts and the new benefits passed under the current administration and the last one, the deficit is likely to fall dramatically in the years ahead. In 2022, the economy should be much healthier than over the last 2 years, but it will also receive much less government support. The initial shock of the pandemic and the subsequent fiscal aid set off a wave pattern in economic output, or real GDP, that has now lasted almost 2 years. Economic output fell in the first quarter of 2020 and then plunged in the second quarter with the peak to trough recession that was the deepest since World War II. Then output rebounded sharply after that, and the economy grew very strongly into the summer of 2021. Economic growth slowed again at that point, largely due to acute supply chain issues and the impact of the Delta variant. However, growth re-accelerated at the end of 2021 and should continue to be very strong into early 2022 as reopening resumes and companies try to rebuild inventories. As we move further into the new year, real output looks likely to exceed the path estimated from its long-term pre-pandemic trend, indicating a full recovery. At that point, with the shortage of workers and much less fiscal and monetary stimulus, JP Morgan expects economic growth to slow to its long-term trend of roughly 2% annualized. In short, economic growth in 2022 should come in like a lion and go out like a lamb. The surge in GDP has been mirrored by a rebound in the labor market as the economy reopens. After shedding an astonishing 22.4 million jobs between February and April 2020, the economy has now recovered 18.4 million jobs, or 83% of the total pandemic loss. That being said, the job market recovery is not quite complete, with the unemployment rate at 4.2% compared to 3.5% before the pandemic. The blue line shows the annualized growth in hourly wages. Wage growth has been rising and is at annualized rates not seen since the 1980s. Putting this together with surging labor demand, this suggests the employment shortfall is primarily an issue of labor supply. Labor supply has been slower to recover as the economy reopens and has likely been constrained by enhanced unemployment benefits, lower immigration, higher costs of childcare, and lingering pandemic fears. This is an important issue for the Federal Reserve, as higher wages should feed through to higher inflation, implying that the economy could reach maximum employment sooner than in past economic cycles. Overall, while the labor shortage is likely to persist for some time, JP Morgan expects some of these pandemic effects to recede, and this should allow unemployment to fall below 4% in the first half of 2022. Half of the story in any investment analysis is valuations, and valuations are very high. Here we see the PE ratio over the last 25 years. Stocks are currently selling at over 21 times forward earnings, which is more than one standard deviation above the long-term average for valuations. For definition, one standard deviation is 68% away from the average. Stock prices based on current forward PE ratios look elevated, although they have come in somewhat over the course of 2021, reflecting a surge in earnings. Earnings continued to grow in the fourth quarter of 2021, and extrapolating these higher earnings into 2022 could lead to a further compression in these ratios. Relatively low interest rates likely justify some elevation of PE. However, these interest rates are likely to rise somewhat in the year ahead, and slowing economic growth, higher corporate taxes, and stronger wage pressures could all impede earnings growth. Consequently, we should take a sober look at valuations and recognize the limited potential for gains in U.S. equities in the years ahead. This slide shows the S&P valuation dispersion over the last 25 years, showing a widening valuation gap between the most and least favored stocks in the market. The current S&P 500 valuation spread is markedly higher than the 25-year average. This wide dispersion in valuations points to an opportunity for using more active management. The deep economic recession was mirrored in big declines in the S&P 500 operating earnings in early 2020. However, earnings have recovered spectacularly since then and hit an all-time high in 2021. This partly reflects the fact that some of the most important sectors of the U.S. equity market, including technology, communication services, healthcare, and consumer staples, saw few negative impacts from the pandemic and in many cases saw stronger revenues. More generally, this earnings have been bolstered by powerful consumer demand and higher productivity as businesses have been able to reduce costs in a more virtual environment. However, going into 2022 and beyond, things will get harder. We are headed towards slower economic growth, higher wages, higher interest rates, and higher corporate taxes. Consequently, we should consider valuations very carefully as the potential for further earnings growth looks much more limited. After multiple years of strong outperformance of growth stocks, most notably during the pandemic in 2020, value began to recover earlier in 2021. However, a combination of declining interest rates, fears about the Delta variant, and disappointing economic data relative to expectations led growth to outperform in the second half of the year. So, does value still have room to run? The left-hand side shows that value stocks remain at historically cheap levels relative to growth stocks compared to long-term averages, and value carries substantially higher dividends. Value generally tends to outperform growth during periods of above-trend economic activity and rising interest rates, such as JP Morgan projects over the next few months. However, we would be wise not to abandon growth stocks altogether, as the economy is likely to slow down to a much slower pace of economic growth later in 2022 and 2023, and growth stocks have traditionally outperformed value stocks in a slow economic growth environment. As you are well aware, inflation heated up significantly in 2021 as surging consumer demand has collided with supply shortages across major sectors of the economy. Inflation, as measured by the CPI, has been accelerating since the start of the summer, with the December 2021 year-over-year gain at 7.1% overall and 5.5% excluding food and energy. These year-over-year gains in inflation have been amplified by weak increases in prices a year ago, and supply chain issues have been a problem as well. In particular, the global semiconductor shortage has increased the prices of a wide variety of goods throughout the economy, and most notably for autos. These higher input costs have sent inflation higher, and this has been amplified by a general recovery in the prices of airfare, restaurants, and rents from their pandemic lows. Fiscal support for low and middle income households has also bolstered the demand for food, leading to higher food prices, while a spike in oil prices to over $80 a barrel in October boosted the volatile energy component of the CPI. Importantly, the PCE deflator, which is the Fed's preferred measure of inflation, is up more than 5% year over year, well above the Fed's long-term target of 2%. JP Morgan believes that much of the current inflation surge will prove transitory, including the energy and supply chain issues. However, the impact of higher wage growth, rising rents, and generally higher inflation expectations should linger, and this should imply inflation that is well above 2% for the remainder of this economic expansion. Since the start of the pandemic, the Federal Reserve has provided significant monetary stimulus by cutting the federal funds rate down to near zero levels and adding substantially to its balance sheet with $120 billion of bond purchases each month. At their November meeting, they started tapering by cutting purchases by $15 billion down to $105 billion a month in recognition of the progress the economy has made toward their two goals of maximum employment and inflation running a little above 2%. At its December meeting, the Fed delivered a significantly more hawkish message, recognizing that the Delta variant has slowed the economic process, but also that the labor market recovery has been robust and inflation may be stickier than they previously assumed. Consequently, the Fed is now proposing to double the reduction in bond purchases down to $90 billion a month, with an eye to completing the process by March of 2022. This should clear the way for increases in the federal funds rate starting in June and the potential for 3 rate hikes by the end of 2022 and 4 further rate hikes in 2023. So what does this all mean for investing? For fixed income investors, the challenge is that the combination of very easy monetary policy and a recession has left 10-year Treasury yields at very low levels compared to long-term averages. Despite consistent upside surprises on measures of wages, home prices, and consumer prices, long-term rates have held steady at around 1.5% after being up to 1.7% earlier in 2021. Policy support for the Treasury market is fading fast, and a new higher debt ceiling has been approved by Congress, allowing for an increased supply of Treasuries. Given this and an economic backdrop of strong economic growth and high inflation, JP Morgan expects long-term interest rates to rise in the year ahead. There continues to be a place in portfolios for fixed income to provide diversification and protection in the case of an equity market or economic relapse. However, given an unfavorable fundamental backdrop for fixed income generally and tight spreads in credit markets, we may want to keep durations relatively short and limit their exposure to credit risks within the bond market. Bonds saw their worst year since 2013 with the threat of rising interest rates looming. TIPS, or Treasury Inflation Protected Securities, offer inflation protection, so they had the highest year-to-date performance due to rising inflation. High yield was next at 5.28%. Longer duration bonds were more significantly impacted because of rising interest rate fears. On the right, we see that a 1% rise in interest rates would impact longer duration funds harder because it takes longer for bonds to mature so that higher interest rate bonds can be purchased. This is why we focus on holding a diversified selection of short to intermediate term bonds, high yield, and asset-backed and mortgage-backed securities in a rising interest rate environment. This chart illustrates that the current default rate of high-yield bonds in blue have decreased to only 0.38% compared to the long-run average of 3.66% in gray. Fed monthly bond purchases have helped support the bond market, so as the Fed continues to taper purchases, we may see default rates increase. Let's look at international equities. While the expected synchronized global recovery has been delayed, it has not been derailed, as you can see with these strong earnings. And vaccination progress overseas has made significant progress, with many countries now outpacing the U.S. In addition, valuations remain attractive, with countries outside of the United States selling at some of their cheapest levels relative to the U.S. in the last 25 years. The blue diamonds represent the current valuation, and it is about equal to or less than the 25-year average shown on the purple bar. International equities also offer greater sensitivity to the powerful post-pandemic rebound, particularly Europe and Japan, where cyclical sectors comprise over half of their respective equity markets. This, along with structural growth opportunities and the prospect of a lower dollar in the long run, all argue for a greater allocation to international equities, with a particular focus on Europe and East Asia. The Purchasing Managers Index, or PMI, is mostly green, indicating accelerating manufacturing with a score of 50 or higher. The November and December data is showing almost all green with the exception of Russia and Germany. Even Japan is seeing some improvement. Globally, we are seeing an increased level of manufacturing as companies try to start building their inventories again. Let's look at how the year ended up with the matrix slide as of December 31st, 2021. Real estate soared to the top spot for 2021, up a staggering 41.3% from its 2020 low of negative 5.1%. Large cap U.S. equities up 28.7%, with commodities close behind at 27.1%. Small cap U.S. equities were up 14.8%, while developed market equities were up 11.8%. The fixed income asset classes were next, with emerging market equities down negative 2.2%, largely due to China. We're just into the first few weeks of 2022 and already we're seeing significant declines in equities and fixed income, while commodities are already up 6.3% year-to-date 2022. This chart reminds us that even though the year may start off poorly like it did in 2021, it can still end up in a much better position. The gray bars show the highest year-to-date return for each year, while the red numbers below show the lowest year-to-date return for the same year. Wrapping up, the U.S. economy has had a bumpy recovery with higher than expected inflation, but is still on strong footing as we enter 2022. And further progress on the pandemic at home and abroad will continue to be a tailwind for the global economic recovery. Given the substantial growth markets have had thus far in the economic cycle, we should continue to focus on fundamentals and maintain a well-diversified stance as we move forward to a hopefully happier and much healthier 2022. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.